In today's episode, I'm going to teach you how to read candlestick charts and how to use specific technical indicators to predict the future. That's right. As active traders, we are ultimately trying to make an accurate prediction of what's going to happen next with the price. Is it going to go up or is it going to go down? We use a combination of educated intuition plus pattern recognition to make these predictions. Now, if we're right, we will make a lot of money. And if we're wrong, we will lose money. Now, as you may know, I am right more often than I'm wrong. I have more than $10 million of verified and audited profits under my belt that back up the strategies that I'm going to share with you today. And although my results are not typical, they are with real money. Now, I am currently in the middle of a small account challenge. I funded an account with $1,000 to see how quickly I could grow it. Today is day 10, and so in this episode, I'm going to use the live trades from this challenge to demonstrate the candlestick patterns and the technical indicators that I'm using to grow this account. So let's go ahead and jump on the screen share. What you're going to see is a pattern, and this is called the whole dollar, half dollar entry. Something that's really important to understand is that stocks especially, but this is also true with cryptocurrency and certainly true with futures and commodities, they trade with respect to psychological areas of support and resistance. These are half dollars and whole dollars. This is especially true when the price is lower. Anytime we have something that's trading below $1, when it comes up to $1, that level is a huge psychological area of resistance. And the reason is because a lot of people say, I'll hold this, and you know what? I'll put my sell order at $1. Or maybe someone's like, they're going to be a little cute. They're like, you know what? I'll put my sell order at 99 cents. Put it just under $1. So people put a lot of sell orders right around these psychological areas. They're just logical. And so the result is that as the price approaches these areas, it often slows down as it comes into this heavy upside wall of sell order resistance. So if we jump onto the whiteboard, what we usually notice is that as the price comes up here, and let's just say this is a psychological resistance level of $2. What's very common, one of two things will happen. Number one, we break through it, and then we come back down and retest the level. This is a retest, and if the price holds here, then this previous resistance is now support. This is fine. The second thing that happens, this is scenario A. Scenario B, which is also very common, is that the price will come up right here and it'll stall out right underneath that level because there's so many sell orders right here. It then pulls back just a little bit. And then if it has a strong amount of volume right here, it can bust through all of those sell orders and surge higher. I like both of these setups, but what's important to know is that if you're just looking at the candlesticks alone without regard for the price, you may be missing the reason that it's stalling out at these areas. Price is a very important component. So let's go ahead and actually look at my very first trade from day 10. So as you may know, on day 9, I had a profit, but we've got to take off the fees and commissions from day 9. So that's going to give me a starting balance today of $2,314. I am just getting in my first trade right here at $2.06. Let's pause this for a moment and jump back to the whiteboard. This is the example right here, the first one, example A, where the price broke over, it pulled back, and it's holding $2. This is the example right at $2. It is holding psychological support. So what I do is I actually press the buy button right here as it's starting to move back up. My stop is about $1.99. As long as it holds $2, I'm going to hold. But if it comes down, there's a lot of selling at 2, and it looks like it's going to break 2, I'm going to get out. This has become psychological support, and it must hold. So with this trade right now, I am in, and my risk is 6 cents per share. I'm in at 206, and my stop is $2. That's not bad. I bought 1,000 shares of this stock. Now, one of the things that has been tricky with this challenge is the fact that because I'm using an international account, I can day trade with as little as, $500, but I set it up with $1,000. I cannot use leverage on any stock under $5 a share. The way leverage works is that when you deposit, and I'll get on the whiteboard here and just show you really quickly for those tuning in for the first time. When you deposit $1,000, this broker gives you 6 times leverage, which means you have up to $6,000 of buying power. Yes, it is still a $1,000 account because that's how much money I deposited, but the broker offers leverage. This is also offered in the US. However, in the US, you need a minimum of $25,000 to have leverage, and you only get 4 times leverage. But that would still give you a $100,000 max amount of buying power. So in this account, the main problem that I have is that lower price stocks, well, I can't use any leverage. So on this one here, I can buy 1,000 shares because I have $2,314 of equity. All right, so I bought it, and my target here is that this squeezes up to the next level of psychological resistance. Psychological resistance here would be 250. However, sometimes lower price stocks like this will also struggle a little bit around 225, the quarter. Okay, so right now I'm up about $63, but it's already starting to stall out, and that's not great. When I got in with a 6-cent stop, psychologically, I knew that I wanted to try to make at least 12 cents a share. That would be a 2-to-1 profit to loss ratio. I call that the golden ratio. All right, so that means I'm going to risk $1 to make $2. So in this case, I'm risking 6 cents to make 12 cents. Now that's sort of the minimum I need in order to justify the trade. Obviously, if I can risk 6 cents and make 40 cents, that's terrific. But if I can't, then it is what it is. So in this case, I decided to sell the position because I got in expecting the stock would continue to squeeze up, and it stalled out. I locked up $13.84 before fees and commissions. That's not a big winner for my first trade, but that is okay. And the risk to reward ratio on this trade made sense. Just because I'm risking 6 cents doesn't mean I'm going to hold until I either hit my max loss or I hit my profit target. I will get out sooner if the price action starts to stall out. One of the philosophies that I have is called breakout or bailout. So if it's not squeezing and it's just sort of stalling out, I'm going to get out of the way. You know what? Maybe my timing was wrong. Maybe I have the right idea, but I just don't have quite the right entry. Or maybe for whatever reason, a new round of sellers have come in at kind of a funny price. And it doesn't really matter because if it's not going up, it's not worth me holding and hoping. Because what I would suffer is exposure risk. The longer you're holding, the more you're at risk of catching a quick flush down and getting stopped out. It's much better just to cut your losses and get out, break even, and then try again a little bit later. Okay, so I do end up taking another trade, but before we get into that trade, let's talk a little bit more about the individual candlesticks. All right, so we're going to jump back on the whiteboard here. So when I was showing you this sort of little diagram here of price right around areas of psychological resistance, we see we come up, we pull back just a little bit, and then we surge higher. All right, and it's very common that this will either be right underneath the level or right over it. So this area here is an area I want to pay really close attention to. This is going to happen at half dollars and whole dollars. So 2, 250, 3, 354, etc. But let's look at the actual candlesticks for a moment. Okay, so if we're looking at the actual candlesticks, and we'll keep it on this side for now. All right, so we're looking at the actual candlestick right here. This candlestick is communicating 4 pieces of information: the open and the low. Now in this case, this is the open right down here. That's the open. This is the low. That's the high right up there. I'll put an H. And this right here is the close. So on this candle right here, the price opened, it dips down just for a moment, it surges up to a high and then closes right here. I would look at this candle and I would say, this is a pretty strong candle. This communicates a lot of strength. Now, if we look at the chart from the last trade, you'll see that the price on this was basically going straight up, especially if you look at the 5-minute chart. It went from 150, 160 straight up to like 207. So what you ultimately have is a giant green candle. So let me show you here. If we have a big green candle like that, what is that telling us? What is that communicating? That's communicating strength. The price is going up. That's exactly what we want to see. Well, what if we have the inverse? What if we have a big red candle? What if the price goes like this? obviously that communicates weakness, right? So we've got strength and we've got weakness. Okay, those are two extremes. Let's look at something in the middle. What about something like this? Now, this to me communicates indecision. The price went up and then went down and then kind of closes, in the middle. It's sort of like there was a little bit of tug of war here. So when we see something that's moving higher and it has, 3 really nice, big, strong candles in a row like this, and then this final candle up here looks like this, I consider that to be a warning that the trend may be about to change. And the reason is because this is showing a high degree of confidence and really strong sentiment in these green candles. And this right here is showing indecision. It's not good to see any indecisiveness at this point in a rally. This is like the equivalent of indecisiveness, as the bride is walking down the aisle. This is not the time to be indecisive. You know what I mean? Like, you want to be nothing but confident in this moment. So when we have the price squeezing up, we want to see confidence. Otherwise, the stakes are so high that if we see any degree of weakness, you know what's going to happen? People are going to start executing sell orders. What's that going to mean? Sell, sell, sell. You're going to start to see that first red candle come in. You see a second, and who knows? You could see a third, and it could come all the way back down. It could do a full retracement. Now, we don't know whether or not it's going to do just a small pullback like this and do the next leg up, or if it's going to do that full retracement. So in the moment, since we can only see what has currently happened, what we need to do is we need to attempt to visualize the other half of the pattern, right? This hasn't happened yet. So how do we visualize what's going to happen next? Well, in this case, the only thing that we can do is we can recognize that this right here is a lot of strength. Now there's indecision. And what we know is that typically when we see that happen, it is a warning or caution sign. It's a signal. It's like an orange light on a traffic light. It's likely that it's going to then give us confirmation of a reversal. And the confirmation of the reversal will be when that next candle goes red. Now, it's also true that sometimes we will stall out and we'll have this candlestick here, which is called a doji, when the open and close are basically at the same exact price, like this. When it has a small body, it can be called a spinning top. It kind of looks like a little spinning top here that kids would play with. There's a couple different shapes that this candle can have. If it has a body like this with a long topping tail, that's called a shooting star. This is a very strong indicator of a reversal coming back down. And if it looks like this right here, that's a hanging man. So the price opened, it dipped down, came back up and closed here, but it shows that weakness is starting to come in on this. So any of those candles are potential weakness. So, and again, I want to emphasize that it's weakness in the context of something that's moved up quickly. In the context of something that's going sideways, these candles don't mean anything. Indecision when the price is going sideways, who cares? Yeah, it's indecisive. The price is already going sideways. It's only a problem to have indecision when the price is really, really extended to the upside or really extended to the downside. That's when it's a situation. That's when it's a problem. So we've got a spinning top, we've got a standard doji, we've got a gravestone doji, we've got a hanging man, we've got a gravestone doji, and then we have the shooting star right here. So these can be, no matter what color they are, red or green, they're not good when they take place at the end of a strong move up. Okay, so I just wanted you to be aware of that really quickly. So when we see something that's made a really strong move up, this is really strong, this is very bullish, this is what we like to see, but we know that inevitably we will have a pullback. The question that you may be asking yourself is, how do I know if it's going to pull back and go all the way back down, or if this pullback is a dip that I should be buying? That is a great question. Okay, so let's jump back up on the whiteboard because I have a good answer for that. One of the things that I have noticed is that when we have one of these big moves to the upside, so we have this nice big squeeze up, then we have a little bit of a pullback. This is fine. Now the question is, are we going to pull all the way back down here and go all the way back down to here, or or is this just a little dip for the next leg up? We want to look at something down here. I'll make this candle a little smaller, which is called the volume profile. Okay, so this is volume and this is price. All right, so we'll separate these like this. So the volume down here, if we saw this volume profile, I would have a pretty strong belief that this is going to continue to sell off. You know why? High volume selling. High volume, light volume move up, and high volume selling almost always results in a decline in price. So the candlestick alone, yes, the candlestick shape, if we have a nice little doji up here, would have indicated the possible reversal coming back down. But this by itself is not going to tell us whether or not we're going to drop all the way back down or we're going to come back up. We need another indicator. And so this is the first of the indicators that I want you to understand. Volume. Now, some people say volume's not really an indicator, but well, it is, of course, an indicator. And it's an important one that it's easy to underestimate. I want to see high volume on the move up and then light volume on these pullback candles. And this candle's fine here. So this volume profile tells a very different story. What this volume profile is telling us is that the price moved up on high volume. The pullback is on light volume. Yes, there's some profit taking, maybe there's some short selling, but it's not like a light volume squeeze up and then just tons and tons of selling. So there's a very different sentiment and market psychology associated with each one of these unique volume profiles. So in this volume profile, we would then want to see the stock move back up. However, let's look at our next indicator. Our next indicator right here is the 9 EMA. This is the 9 exponential moving average. I like using exponential moving averages because they react faster to changes in price. So when the price starts moving up very, very quickly, the exponential moving average moves faster because it weights more recent price action more heavily than the older price action. A simple moving average will move a little bit slower because it's not weighting recent price action more heavily. A perfect pullback will come down right to the 9 EMA. It'll almost tap it. It'll almost just give it a gentle little kiss. And then, boom, we come right back up. So this 9 EMA is psychological support as well. Now, the trifecta perfect scenario is when you have all of this plus this right here is $2 a share. Or let's say this right here is $7 a share. Let's use this, and I'm going to be foreshadowing my next trade. All right, so let's say this is $7 a share. The price has squeezed up here to maybe about $7.25. It's pulled back just a little bit. It's holding support at the psychological level. This is a perfect spot to look for a dip entry. Now, it's true that confirmation will come when this candle actually makes a new high and buyers start to come back in and volume begins to increase back up. That's going to be confirmation. All right, so getting in anytime before confirmation, I'll only use with small size, but taking a starter down at this area right off of the psychological support and right off of the whole dollar and the psychological support of the 9 EMA, what this can do is can give me a really tight stop. But getting in at 725 or something like that for the move up to 750, 8, and 9, that's okay too. Let's go ahead and look at trade number 2. Okay, so we have a stock up right now, about 15%. Now, this stock just did a 1,000 to 1 reverse split, which is really crazy. It was 6 cents the day before, and because the reverse split is now trading at $6 a share. The float is also 1/1000th of what it was yesterday. These are the types of stocks that can move very, very quickly, and this one's been beaten up for a long time. So right here, it breaks over 7 and it dips for a moment and I end up punching this buy button. I try to buy that dip. I get filled a little higher. I was trying to get filled right at 7 and I'm looking for the move up to 750. There's 750 and then 8, 850 and now 9. Do you see how it's trading right at these psychological areas? This is literally following those psychological areas to the penny. It goes from 650 to 7 to 750 to 8 to 850 to 9. I lock up over $600 on this trade. So this was an example of buying a chart pattern that I would call a micro pullback. And it just so happened that this was positioned around that classic half dollar, whole dollar area. We see it time in, time out. Again and again and again, we see this pattern at these prices. So one of the things that I'm doing while I'm trading, I am watching my scanners. So as I see a stock moving up the scanners, I'm looking at the price very carefully. And if I see a stock hit the scanners and it's at like 702, and I see a big buyer at 7, you know what I'm going to think? I could get in right here with a stop at 7 because I'm getting in right at psychological support. Now, I will do that even if we have an example where the price is very extended right here. I could get in if I just have the luck of the draw that I pull it up right at 701. I could get in right here at 701. I could set my stop at $6.99 or $7. And if this thing wants to keep going, as you just saw, sometimes they will, and it wants to go straight up to 750 or straight up to 8 or 9, I have seen candlesticks that literally went up $10 a share. And sometimes people will say, Ross, I don't understand how you possibly managed to get in that. You know, all I'm seeing is one giant green candlestick. Why did you buy where you bought? Half dollars and whole dollars. Buying around half dollars and whole dollars is one of my favorite ways to quickly get in something that's moving. Now, the other thing that I really like is to trade what is called a micro pullback. Now, what I want to do actually for this episode is if you guys look down in the descriptions and pin to the top comment, you will see a link to download my micro pullback strategy. This is a strategy in a PDF. You can download it, you can print it out, you can put it right next to your desk. That is going to come hand in hand with my technical analysis series, which is also a PDF guide. I want you to download, you'll be able to download both of them, and I want you to print them out, put them next to your desk. These are going to help you identify these patterns in real time, because one of the biggest challenges for beginner traders is that when you're looking at the pattern forming, you only see half of it. You don't see the full pattern until it's over. So what I need to do for you is help train your eye to recognize the pattern when it's in half form and to be able to see the rest. Now, you know, if you see half a giraffe, it's very easy for you to be like, yeah, I know what's coming next. It has a huge neck. Giraffes have huge legs, they have a huge neck. That's obvious. If I show you half a stop sign, you know what the other side looks like. Your brain knows immediately, but you're just now learning the language of the financial markets. So for me, I know it immediately when I see half of a bull flag, when I see half of a micro pullback, when I see half of a head and shoulders or half of an ABCD pattern, I know what's coming next. Now, I don't know it with 100% certainty because even the perfect patterns sometimes will fail, as you'll see in one of my upcoming trades, but I have a high enough accuracy, 65, 70%, sometimes higher, and that is enough for me to be very profitable. So I know with a high degree of certainty what's going to happen when I see this part of the pattern. But again, that part of the pattern has to be combined with volume profile and the right technical indicators. So let's talk a bit about some of these technical indicators just for a moment. So I already shared with you my first one, which is volume. So volume bars, and these should be colored red or green. I'm sorry, I inverted that, but green or red. And then we want to see, and this is going to be based on the price of the candle. If it's a green candle, you want to see a green bar. If it's a red candle, it's a red bar. It's very important. And then you want to see the 9 EMA. And I use this on all time frames, 1 minute, 5 minute, daily, all time frames. I use the 20 EMA. What I find is that you have these sort of two moving averages. You've got the 9 and then you have the 20. The 9's always going to be closer to the current price. So when the price moves up very quickly like this, you're going to have the 9 first. So when it comes back down, if it is not able to hold at the 9, the next level that we look at is the 20. Usually if it breaks the 20, it's all over. But the confirmation that it's all over is if it breaks volume weighted average price. Volume weighted average price is a technical indicator. I have it in my charts as an orange dotted line right down here. And this is, I call it kind of like slack tide. This is the equilibrium of the stock on the current day. It is factoring in all of the volume that's traded and at the prices that each of those shares is traded at to give you the average price of the stock, the volume weighted average price. That's why they call it that. It's brilliant. It makes a lot of sense. This is really helpful because if the stock is below it, inherently, the bears are in control. If it's above it, the bulls are in control. So if it's above VWAP, it's bullish. If it's below VWAP, it's bearish. There are rare instances where I will, as a bullish trader, buy something that is below VWAP with the expectation that it's going to curl back up, but it's very rare. I primarily focus on trading above VWAP, and for most beginner traders, that really is going to be the safest place to trade. Now, the next indicator actually that I forgot to mention, but I'll add right here is, let me do it in purple, MACD, which is moving average convergence divergence indicator. And so this is kind of an interesting indicator. The way this works is, I'll erase this. This is okay to erase. So the way the MACD works is it is an oscillating indicator. So you'll have typically your chart will be in three panes. You'll have volume, you'll have MACD, and you'll have price, like this. So your volume bars are going up and down, right? Your candlesticks going up and down. Not going to color them, but you get the idea, of course. And then you've got your MACD. So your MACD is going like this. And it goes like this. Like this. So you have the moving average, and then you have the signal line. And I trade when the MACD is above its signal line. And when it crosses over right here, from that point forward, I expect the price action will be much choppier. And I generally don't want to take too many trades. And actually, to be honest, this is a Picasso because I did this perfectly. This right here is about where you would expect the MACD to cross over. And it will cross back up as it's coming back up. We'll just move that like that. That's all right. It doesn't have to be perfect. Anyways, so basically what happens, the price is moving up. And so your moving averages, let's get the 9 EMA is coming up right here, right? Like that. And then you've got your 20 EMA that's down here. So when the price is moving up, the moving averages are converging. They're pulling apart. They're separating. Okay, so this starts to open up. And then once the price action starts to compress and consolidate, those moving averages come back together. So all of a sudden the MACD or the 9 EMA curls back down, and then the 20 starts to curl back down. And some people actually trade just based on moving average crossovers, like right in here when the 20, that one's gone. When the 20 crosses the 9, some people would take a trade right there. That's not something that I do, but I do pay attention to the moving average crossover on the MACD. So when the MACD crosses over right here, I usually sort of steer clear. When it comes back up and goes positive, I may take another trade, and I will occasionally take a trade down here on the pullback, but usually the cleanest price action is when it's open, and this is specifically on a 1 minute and a 5 minute chart. I don't use it particularly at all on the daily chart. All right, so now let me show you the micro pullback. So the micro pullback occurs when you get a quick move up and then just a brief pullback. You will visualize this actually better in the live trading recordings than really on a chart because it happens so quickly. So we get this this quick move to the upside. I'll just erase this. We get the quick move to the upside right here like that. We'll just do it in blue, it's fine. And then we get sort of just a moment of pullback, and then the price. So sometimes you might have like just a moment of doji, and then the price continues higher. Now, it probably wouldn't be a doji, but this is going to be on like a 10-second time frame. It's a super fast time frame. So the price moves up, it pulls back, it goes higher. And so 10 seconds, so you're going to have 6 candles like this in a 1 minute candle. So 1, 2, 3, 4, 5. So let's say there's another one down here. So the 1 minute candle would look like this, straight up, right? So traders are going to say, Ross, I don't understand how you got in right here. Well, you know what it probably was? This micro pullback, very good chance it was around a $0.50 or a whole dollar. So maybe this was 7 on the top, maybe it was 7 on the bottom, it broke above it, held above it, and then it goes, or it approaches it, it pulls back, and then it goes. Whether it's scenario A or scenario B, this is that spot where I'm often a buyer. So right there in the middle of that pullback. So I encourage you guys to download the PDF on my micro pullback strategy that is pinned to the top of the comments and linked in the description. Print it out on your desk so you can have it, so you can study it and start to memorize this pattern. This is the micro pullback pattern, and I love trading it. Now, let's look at my next trade, and this is actually going to be my trade for day 11. So day 10 finished in the green, big green day, and then I come in on day 11. Well, I end up trying to trade what's called an ABCD pattern, and I'm going to show that to you in just a moment, but let's look at the trade first. Okay, so on this trade, I'm getting in anticipating a break through the high, and I bought a measly 600 shares. Why did I buy only 600 shares? Well, I think you know the reason. It's because the broker that I'm trading with doesn't offer leverage on these lower price stocks. And one of the things I said in my last episode is that I really should just avoid trading this price range entirely because I can't buy enough shares. And when I can't buy enough shares, I'm not going to trade the position the way I normally would. So what I would normally do on this particular trade, it's an ABCD pattern. So let me show you on the chart what that looks like. In an ABCD pattern, you have the first leg up, you have a pullback, it comes back up, but on the second leg up, it doesn't make a new high. Now, one of my favorite chart patterns is a bull flag. In the case of a bull flag, we have the move up. We usually have 2 or maybe 3 candles of pullback. Now, typically this all will correspond with half dollars and whole dollars. The pullback is going to come down kind of close to the 9 moving average. And then what ends up happening is as the first candle makes a new high, it hits resistance and it is unable to break through the top. And so it pulls back a second time. It pulls back a second time, and then when it comes back up for the third time at this price, this is where we're looking for that resolution right there. So this is a classic pattern. It's a bull flag, and then it becomes an ABCD pattern. It's typically a failed bull flag that then resolves as an ABCD pattern. In fact, a lot of times the reason it fails is because this is so extended. So as it's forming, it doesn't actually hit the 9 moving average until it pulls back at the second point right here. So this is very common, and this is a 5-minute pattern, and it's also a 1-minute pattern. Okay, so in this pattern, typically the way I would trade it is I'll either buy right down here off of support, which is a dip trade, but this is a little too risky for the small account, so I'm not taking that trade. Instead, I'm buying basically as it's approaching the high, and I'm looking for that squeeze right through the high. I'm looking for breakout. Now, I don't end up getting it, but I don't follow my breakout or bailout rule. I end up holding it because my position is too small. The problem here really comes down to position. Because I was holding only 600 shares, when I was up 20 cents a share from 415 up to 438, I didn't take any of the profit off the table. It's only $100 is what I was saying to myself. I'm looking for this to break 450 and go up to 475 and up to 5. I usually don't swing for that big of a winner, which is, nearly 25% move. But in this case, because I could only buy 600 shares, I was being a little bit more aggressive with that profit target. Well, let's look at the result. The result on this is that I end up holding way too long and the price begins to come back down. So right now I'm in at $4.15. We're at 418, 420. The high a day is 429. There's 420 on the offer. Already you can see it's a little heavy. It's got a little bit of resistance here. It's not breaking as well as it should. You may also note on this chart pattern that blue ascending support trend line that I drew. These are very common during ABCD patterns. If we look at it briefly on the chart, we might connect the low here and the low here to create this kind of support line. Okay, so we're still at about $4.12. This is a point where right here, it would have been perfectly acceptable to get out of the trade based on the breakout or bailout philosophy. It didn't go right away. There it goes up to 438. And did I take it off the table? Nope, I could. I'm up $85. I'm not taking any of it off the table. I'm holding and hoping for a bigger move. And this is a mistake. And then when it comes down to break even, and that happens very quickly, all of a sudden I'm a deer in the headlights. Uh-oh, I'm break even. I put out the sell order, try to get out with a little profit, and then I don't get filled, and now it's 410, now it's 402, 380. Look at that drop. Now I'm down $150 on this trade. This is not a good example of good risk to reward management. ultimately I end up losing over $300, and I didn't stand the chance realistically of making $600 on this trade. I didn't. And you know what? I had $100 of profit and I didn't take it off the table. Now, if you notice right here, it comes down to this blue ascending support trend line, which is why I held right here instead of selling just yet. But I shouldn't even still be in this trade. First of all, I should have gotten out for profit when it hit 430, but I really should have gotten out sooner when it was just going sideways. So here, day 11, I took one trade. I go in the red, $349.43. And just like that, I hit my max loss. So now I'm at max loss for the day. The fact is, with a small account, and I came into the day with just under $3,000 of equity. So I had said, I really don't want to be risking more than 5% on any given trade. And I don't want to be going down more than 10% in one day. Well, I just went down a little more than 10% in one day. That's not great. But the good news is I did just have a really big green day on day 10. So I'm still positive between day 10 and day 11. And now let's look at trades from day 12. So coming into day 12, I have $2,604.92. Had to take away the fees and commissions from day 11. And my first trade here is on the break of a whole dollar, $1. I'm in $1.08. My stop is $1, which means I'm risking 8 cents a share. Immediately this stalls out, and when it stalls out this quickly, I am getting out of the position. I'm like, nope, I don't trust it anymore. This should have immediately ripped up to 115, 125. When we have a break of $1 a share, it needs to break with some real conviction for me to be willing to keep holding it. So I'm in it with 435 shares. I took a little off the table. I got a partial fill at 110. And now I'm pretty much just trying to figure out, is this going to pop back up through 110 very quickly so I can get out on the offer with some profit? Or am I going to have to just hit the bid and bail? So it comes back up to 108, 110. And it looks like there's 110 on the offer. 110 on the offer. I've got $1.30 of realized profit on it because of the 65 shares that I sold. But right here, the stock is up 55% on the day. It's got volume, it's moving, but it's just, it's not really working. So anyways, locked up that trade, $1.30 of profit, nothing to be that excited about, but I do end up getting back in for a second trade. Okay, so on my second trade, it's grinding a little higher, and I'm like, all right, I'm gonna give this a try. I'm gonna use 1,500 shares. I put it in for 2,000, and I'm like, nah, I think I press it, I don't get filled, too much buying power, not enough buying power, too much share size, reduce it to 1,500 shares. I get in right there, sort of a slow fill, but I'm in at 120. I'm looking for the break of 125, and then I'm thinking, all right, maybe this will speed up here to 135, 140. On the bid, we do have a big buyer there at 120, but once again, it feels like it's kind of stalling out. So we've got 122 on the offer, 121 on the bid. I'm up 1 penny a share. Now with 1,500 shares, that is $15, but this thing is really testing my patience. There's 124. It's just not giving me the big win I was looking for. And so on this, I end up bailing out, hitting the bid. And now I'm up, I can't tell if it's $15 or $16.58. And the reason that I can't tell is because, my monitor is still broken. So, as you know, as part of this small account challenge, every time you guys hit the thumbs up, you are getting me 1 thumbs up closer to unlocking my new piece of inventory. Every time we cross over 10,000 thumbs up in this series, it helps me unlock a new piece of inventory for my trading station. And the next one that I'm going to be getting is a new monitor. I'm going to replace this one, which is broken. When I began this challenge, I started with an old laptop with 3 broken keys and this monitor that had been dropped on the ground and is broken sort of on the side here and on the bottom here. So by the time you guys are watching this episode, which will probably be about a week from today, I actually think there's going to be a really good chance I'm already over the 10,000 thumbs up mark. And at that point, I'll be using a new piece of equipment. So as of the moment, just before we upload this episode, this is where we are at on thumbs up and subscribers. Now, I also said once we cross 10,000 new subscribers, I will reset my account back to $1,000. And we are getting close. So thank you guys who have hit the thumbs up. Thank you guys who have been subscribing. Once I get that new monitor, my next piece of inventory will be another monitor. There's actually a rule of thumb. The more monitors you have, the more money you make. I'm almost positive that's science. And I will have 100 monitors in here if we get enough thumbs up. So help me hit my next goal, hit the thumbs up, and let's go ahead and look back now at the next trade. All right, so in this trade, we have a stock that's squeezing up right now and has news, and it came up just under the whole dollar of $2. So what I do on this is I buy a dip. As it dips down, I buy the dip for the curl back to 190. This ends up being another trade that doesn't work out very well. So it dips down right there. Actually, it's kind of lucky that I got filled where I got filled because I pressed the buy button before it dipped that much. Then it pops up and I was like, well, you know what? I think I'm just going to get out of this thing because I wasn't expecting it was going to dip that much. You could see the candle is a big red candle. At that moment, what I was looking for was just a little bit of consolidation right underneath that whole dollar. So we had the initial pop up to about 190, a little pullback just for a second, and then I was looking for this breakout. I pressed the buy button right here. The moment I pressed the buy button was a red candle, and my order miraculously filled down here. So it pops up a little bit, and in this case, well, it's a small winner, about $12. So I'm 3 trades into the day on day 12, and although some would say I'm making progress relative to losing $349 on day 11, it doesn't feel like very meaningful progress. And the fact is, each time I'm trading with 1,000 shares, I'm risking $60 to maybe $100. So to risk $60 or $100 and only make 12 or 15 or whatever, that's just not very good risk to reward. So unfortunately, this is a day so far that's already showing me that there just doesn't seem to be a lot of things that are moving and that are holding up. Okay, so now my final trade for day 12, we've got PTPI, another stock with news squeezing up. It currently has a high of $1.60, and right now it's doing a micro pullback under this level. I put the order at $1.50, but I hesitate just for a moment. Then there's a 30,000 share buyer on the bid. It goes to 55, 52, 54, 55, back to 53 with an 8,000 share seller. This is analyzing the tape, which is also known as the level 2. I see that seller 53 and I'm like, I'm getting a little unsure about this. I don't know. Then it goes 56, 58, 58 on the offer, 58 on the offer, and it stalls out again. 59, 60, 5,000 shares. 62, 63, 64, 65. Now I'm thinking, all right, shoot, I kind of missed this opportunity. Should I get in here? 66, 67. So I move the order up. I press the buy button for 62 and I don't get filled. Well, I was being a little trying to get filled on a dip, did not get filled. Move the order up to 68. Watching. Green on the tape, no fill. I don't have enough buying power. Gosh darn it. Now I've got to change my share size. So now I'm starting to get into a little bit of a chasing situation. It goes up to 178, 182. It's just moving higher, and I'm watching the price. So right now in this moment, I'm actually watching the price more than the candlesticks. I'm watching the order flow. I'm seeing the green on the tape. I'm seeing all these buy orders. And that's telling me that obviously people are coming into this. They really like it. And so I'm watching this dip right here. We get another dip down to 177. So now we're at 180, 181. Sort of moment of truth here. This is another micro pullback. On the 10-second chart, we can see the green candles up, the little bit of pullback here. I've got my order loaded for 1,200 shares, and I'm looking for the break over 2. So in this case, what I'm actually doing is I'm going to take a trade right here in at 93, and I'm looking for the squeeze through $2. Because there's so much strength, what I am thinking will happen is that we'll break over 2. Now, this is a little tricky. All right, we're right at that $0.5 whole dollar. 2 on the offer, 202, 204. Time to take some profit. I'm taking a little off the table. This ends up being a small winning trade, a little under $100 of profit. You know, it wasn't great. It would have been a lot better if I had gotten filled earlier, but the micro pullback at about $1.85 worked. So this was again, a combination of trading a micro pullback that corresponded with price action around the $0.50 and the whole dollar, which in this case was resistance at the $0.50 or resistance at $2, which I thought it would be able to break over. And I was correct. In this trade, I lock up $98.04, which puts me up $127.25 on day 12. So this is a week where I focus on some basic candlestick patterns. I utilize my indicators, including volume, moving averages, volume weighted average price, and of course, MACD. And I was able to get some nice trades around $0.50 and whole dollars on micro pullbacks with bull flags and first pullbacks and ABCD patterns. As it turned out, the ABCD pattern that I traded wasn't the most impressive. It was sort of disappointing that we got that pop and then that rejection. That is going to happen. And that was an example that really highlighted how, with a regular account, I would have made money on that trade because I would have taken my profit. But because I'm in a small account, I changed the way I normally trade. Instead of taking the basic off the table, I held for a bigger move. So once again, I'm in the situation where I'm asking myself, why am I trading stocks where I can't buy at least 1,000 shares? Buying 600 shares, really, it cost me $350. Obviously, that's how much I lost. And it was an avoidable loss. Because I got into the position with 600 shares, I was sort of doomed from the start because I was already positioning myself with such small share size that psychologically I would feel like the win wasn't big enough to make up for the commissions and it wasn't even worth taking the trade. So going into day 13, day 14, day 15, I need to continue to focus as much as I can on stocks that are going to be within my real sort of sweet spot for this small account challenge. That's going to be stocks between 5 and 10. It's just so happened to have been the case that these last 12 days, 13 days so far, 12 days, most of the stocks that have been really active have either been too cheap or too expensive, which means at this point in the small account challenge, the best thing for me is to be patient and be disciplined and be really okay with not trading every single day. If you have not already downloaded my micro pullback strategy PDF, check down in the comments pinned to the top and in the description. You can download the micro pullback strategy as a PDF, print it out. You can use it in your own trading today, but I want to encourage you as always to practice new strategies in a simulator before you put real money on the line, because my results are not typical. When you download the micro pullback strategy PDF, you'll also get my technical analysis series guide, which gives you a written breakdown of the way I use technical analysis in my trading. And I want to thank you as always for tuning in. I hope you hit the thumbs up, help me unlock the next piece of inventory. And if you're not already subscribed to the channel, hit that subscribe button and I'll see you for the next episode real soon.